Hey guys, it is Patrick, and before you dive into this lesson, I wanted you to know that you're about to start a new section of Principles of Accounting, and you can actually head to my website at www.patrickleemsa.com, where you can actually purchase and then download and then print the worksheets that go along with this lesson and all of the lessons that are connected to this section of Principles of Accounting. It's a great way to take notes so that you can actually concentrate on what I'm teaching you in our lessons, and then you can able to write notes along with the notes that I am showing on your screen. So all you have to do is head to my website at www.patrickleemsa.com. There you can purchase them and then download them, and then you can use them on this and all of the lessons that are connected to this section. So go ahead and do that. And if you are ready, let's head into our first lesson in this section right now. Hey guys, it is Patrick, and I wanted to welcome you to this Principles of Accounting course. In this section, we are going to give you an introduction to financial accounting. We think of this as the foundational knowledge you're going to need to know as you go through this course. So that's what we're going to do here. Now, in this lesson specifically, we're talking about organizational types of businesses. And what we mean by that is when you start a business, you're going to have to classify it in a certain way for tax purposes or for legal purposes. And we're going to give you kind of an overview of the different types that are available to you as either a business owner or as a consultant to another person who is starting a business. So let's get started here with talking about the two different ways we can classify a business. Now, this comes from tax law, and so we're kind of borrowing some of these things from tax law, and as you go through this, you'll kind of understand what we mean by these two different classifications. The first one is we think of them as one and the same of the owner. So we don't think of the business as a separate entity to the owner. We actually think of them as the owner, and that's kind of weird, but I'll give you the definition here in a second. The other way that we can classify it is we can classify the business as a separate person from the owner. Now, person is a technical term for from a tax perspective. Even though we think of persons as a human being, from a tax perspective, a business can be a person, a tax-paying person, separate from maybe you and me, who might be the owners of that business. So we have one and the same, and then we have two separate. We have the business as a person and you as an owner of the business, but you're also a separate entity. Okay, so let's go into this just a little bit deeper. When we talk about one and the same of the owner, when the company makes money, the income and or loss will also go on to the owner's tax return. So if the business makes money, that income also goes onto the owner's tax returns directly. So the company doesn't prepare a separate tax return, so they're not separate, they are one and together. Now, this is different from a separate person. So a separate person here, when the company makes money, the income is separate from the owner and it files a separate return. So what basically happens to a business in this situation is the business will make money, they'll prepare their tax returns, they'll pay taxes on their own, and then whatever's left gets distributed to the owners, and the owners have to pay their own taxes on their end. We call that double taxation. But again, we're not in a tax class, just trying to help you understand what's going on there. Now, there are other legal separation activities too, not just financial ones, but this is kind of the most basic that you need to know. So we have one and the same of the owner and then separate from the owner. Now, generally speaking, there are three organizational forms, and these are legal entity forms for a business. So you get to choose. The first one we have is sole proprietorship. You might have heard that around. Then we also have partnerships. And then finally, we have corporation. And we're going to take some time to explain each one of those in a few minutes. But the three organizational types we got is sole proprietorship, partnership, and corporation. And those are kind of the big three here. Some might say, well, what about LLPs or LLCs or estates and trusts? Those are a little bit different, and for sure they're important, but they also can be classified into one of these three types. Now, many of these types of businesses are based on federal tax law. So remember, bringing back tax into all of this, that's kind of where we get these terms here. All right, let's talk about each one of these. Sole proprietor, typically owned by one person. Usually it is owned by one person. Keyword here is sole proprietorship. This is the easiest form of business that you can kind of open up. Usually it does not include a separate registration with the state or federal government, other than maybe a business license to do business in a city or a county. Typically, if you say today, I'm going to start a business, you started a business. You don't need to tell the state anything. You don't need to tell the federal government. Of course, you still need to pay taxes. But besides that, you don't need to do any registration paperwork from a state or federal level. Now, income or losses are attributed to the owner rather than to the company itself. So when the company makes money, it's as if the owner made the money. And that's why we think of the owner as the company, and the company's income has to go on the owner's tax return. Now, the problem with this is that it has unlimited personal liability. So if you started a bakery and you were a sole proprietorship, someone gets hurt by slipping and falling in your store, they not only can sue you, the company, but you personally. So if the company has no assets, that person can technically go after your own assets, which could be your home, your future income, your investment assets, your cash, all of that, because it has unlimited personal liability. So what you're giving up here is unlimited personal liability, but then you're also getting an ease of formation because you can literally be a sole proprietor today without doing any paperwork or registration fees with the state or federal government. Now, the next type we have kind of goes along with this. This is a partnership. It's owned by 2 or more people, hence the word partnership. Similar to sole proprietor in all aspects except for this. It has more than one owner. Usually a partnership agreement is needed, but doesn't need to be filed with the state. So typically when you start a partnership, you kind of get together with a lawyer and you draft up a partnership agreement. Typically that's the one step, but that doesn't have to be filed anywhere. You just need to keep it. Now, this is now income is split between all owners based on their percentage of ownership. So if you own 60% and your partner owns 40, then whatever income the company makes at the end of the year, you would get 60, your partner gets 40%. So there's typically a split based on ownership percentages. Unlimited personal liability. So again, you open yourself up to unlimited personal liability. So if someone again slips and falls, they can come after you personally. So that's partnership. Let's move on to a more kind of different one. And we have corporation. This is owned by 1 or more persons. And so a corporation can be a single owned corporation. So you opening up a corporation and that's it. Or it could be a multitude of partners that together will open up a corporation and own different percentages. Now, owners these are what we consider as separate legal entities. So the last two, one and the owner. This one, separate from the owner. It's basically a person in itself. So Coca-Cola would be a separate person from all of their owners or shareholders who might own a portion of Coca-Cola. Corporation is legally responsible for its own acts, including debts. So when the corporation goes out and takes out a loan, they're taking out the loan in the name of the corporation, not necessarily the name of the owners. If you're sole proprietorship, typically you're taking out debt in the name of the owner and the business as well. Expensive and complex to form, and it's relatively it's not that expensive, but there are expenses associated here that wouldn't be associated with sole proprietor, for instance. So you might have to incorporate with the state in which you are operating in. Well, there might be a $500 or $600 fee to file that. You might have an annual payment that you have to make to the state, including your tax. Sometimes it's called the minimum tax, or sometimes it's called the annual renewal registration fee. Whatever it might be, there are some fees that are associated with this that are not necessarily associated with a sole proprietorship. Now, the one thing about corporation is it does have double taxation because the corporation itself is going to get taxed. And then after it's taxed, any additional funds that the company has can be distributed to their owners, and their owners are going to pay what we call dividends tax. And so obviously, double taxation means less money for the owners. So you're giving up double taxation for something that we're going to talk about in a few minutes, okay? Going on with corporation, Owners own share in the corporation, so a share represents an ownership in the corporation. So typically how it works, it's not that you own 20% of the corporation, someone else owns 80% of the corporation. It's that you own 200 shares and someone owns 800 shares, totaling 1,000 shares. So 200 divided by 1,000 is 20%. So technically you own 20%, but you actually own 200 shares versus 20%. And then if you sell another 1,000 shares to someone else, you went from 20% now down to 10% because you would own 200 of the full 2,000 shares available. Now, shares can be traded either publicly on a national exchange or non-publicly between people. There are specific rules to all of this, but publicly traded shares can be traded publicly, so you can go onto your phone and actually buy shares of a company, or there might be corporations that are not public in which you would have to find someone who's already an owner and buy shares directly from there or buy their shares from them. Now, a corporation can be private, not traded on a national stock exchange, or public. We call that a public company. That public company is traded on a national exchange, which can be easily to trade shares of ownership. Now, moving on from corporation. So those are the three: sole proprietor, partnership, corporation. We do have some other ones that I thought it'd be interesting to talk about. The first one is the limited liability corporation or the partnership. Going back to the corporation really quick. Corporations have separate liability from the owners. So separate liability from owners means that the owners are not necessarily liable for the corporation's debt up to the extent of their own investment. So that's the trade-off there. All right, so limited liability corporations and partnerships, state designated organizational types. This is not a federally recognized organizational type. And so basically the LLC and LLP came about because people wanted the protection of a corporation, but they want the ease of formation of a sole proprietorship. So this is in between the sole proprietorship and the corporation, kind of right in the middle. Same thing with partnership. So partnership and corporation, it's right in the middle. So this is that middle one where you get the benefits of a corporation, limited liability, but then you also get the ease of formation when it comes to just paperwork and making it easy and not have to do with corporate minutes. So the federal government doesn't recognize LLCs or LLPs. This is a hybrid between corporations and sole proprietorships and partnerships. Less work to operate from a corporation standpoint, but paperwork is still involved because you have to register with the state and pay a fee and all of that stuff. But it's so much simpler than being a corporation because you don't have to worry about corporate minutes. Now, our focus here in these videos are on corporations. So we're only going to be talking about corporation. We're not necessarily going to talk about sole proprietorships or LLCs or LLPs or partnerships, but they may come up. So whenever we're talking about an example, think from a corporate standpoint. Think the Amazon and the shareholder of Amazon. Think of Coca-Cola as a corporation versus the shareholders and owners of Coca-Cola. We're not going to be talking about an example of a mom and pop opens up the shop on Main Street and they sell widgets to people that walk by. That is a sole proprietorship or that's a partnership, and so that's not a corporation. So our focus is a corporation in this course. Corporation is a separate entity from its owners. So we're going to do a ton of examples, and you're going to see that we're talking about this from a corporate side, not the owner's side. All right, so hope you have a better understanding of organizational types of businesses. There is a lot there, but the main goal here is to help you understand the different types and then understand that we are going to be talking about corporations from here on out. So thanks for watching this video, and we'll see you in the next lesson. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? put that in the comment section below, and I'll respond to you on what you got out of this video. So hope you enjoyed this video, and we will see you in the next lesson.